Four companies just committed up to $760 billion to AI this year. They can't stop. They can't slow down. And none of them are sure the money comes back. Now here's the part that should scare you. Every single one of them knows this might not pay off. And they're spending anyway, faster. Because the moment one of them blinks, they lose the whole war. Hey, if we haven't met yet, I'm the digital avatar of Karuna Santosa. He built me to do one thing: track the AI, harvest the hype, and follow the money. So, while he's busy reviewing the script for what's next, I'm stepping in to make sure you don't miss this one. He reads every single comment. So drop your thoughts below. Let's get into it. Here's the mechanism I want you to understand. This isn't a story about four rich companies making a bet. It's a story about a trap. A trap where the only move that feels safe is the one that bankrupts you slowly. Economists have a name for it. They call it a prisoner's dilemma. And once you see it, you can't unsee it. Let's start with the surface, the version Wall Street cheered. On July 22nd, 2026, the earnings came out. And on paper, they were beautiful. Google pulled in $119.8 billion in a single quarter. Their cloud business grew 82%. Amazon's cloud grew 37%, the fastest in 18 quarters. Microsoft beat estimates too. Meta beat on revenue. Every headline said the same thing: the AI boom is real. That's the version Wall Street got. Now here's what that coverage left out. Beautiful numbers, happy shareholders, the future looks bright. But that's the surface read, and the surface is always the part they want you to see. So let's look at what the surface was hiding, because underneath those beautiful numbers, something was breaking. Start with Meta. Meta spent $31.1 billion on AI in one quarter. 90 days. Now watch what that did to their cash. A year ago, Meta's free cash flow was $8.5 billion. This quarter, $784 million. Let me say that again slowly. Their free cash flow collapsed. 91%. That's not a rounding error. That's the sound of a company setting its own bank account on fire. And Meta wasn't even the worst signal. Look at Microsoft. And here's the number that should stop you cold. Microsoft spent almost $200 billion on AI. Then they raised prices on their own customers. And their flagship AI product, Copilot, 3.3% adoption. Barely 3. Out of every 100 business users paying for Microsoft, barely 3 even touched the AI. So they spent the fortune, they raised the prices, and almost nobody showed up. That's the real read. The invoice is enormous, and the return is a whisper. Now here's the tease I want you to hold on to. There's one number buried in these filings that tells you exactly when this whole thing breaks. Most analysts are watching the wrong one. Stay with me, because by the end of this, I'll hand you the right one. So who's actually getting paid in all this? Because $760 billion doesn't just vanish. It goes somewhere. Follow it. Every dollar of that Capex flows down the same pipe. First stop, Nvidia, the chips. Second stop, TSMC, the factory that actually prints those chips. Third stop, a Dutch company called ASML, the one machine that makes the chip. If you've been watching this channel, you already know that name. ASML is the choke point of the entire modern world. Now here's the number that makes this concrete. This isn't Nvidia. AMD, Nvidia's biggest competitor, just posted $6.7 billion in data center revenue. One quarter, 107% growth from a year ago. The Capex isn't disappearing into theory, it's landing. And then the money keeps flowing, into power, into land, into the electrical grid itself. Think about what that actually buys. Not code on a screen, steel copper turbines cooling water. The kind of thing you can walk up to and touch. So here's what that number actually means. Big tech isn't buying software. They're buying physics. Chips factories, electricity, concrete. And that's the trap tightening. Because you can print software overnight, but you can't print a power plant. You can't print a chip fab. That stuff takes years. Which means the spending can't stop and start. Once you're in for a decade. And this is where the real architecture becomes clear. Why can't any of them just slow down? They see the collapsing cash flow. They see the 3.3% adoption. Any rational company would pump the brakes. So why don't they? Here's the answer. Google's own finance chief said it out loud on the earnings call.
Thanks for the question on how do we think about forward-looking CapEx in the context of supply constrained. So we're still in a supply constrained environment. I think we've said this now for multiple quarters in a row. And we are seeing very strong demand, both from external cloud customers as well as across the business. And our goal is to invest as long as we see an attractive return on that investment, as Sundar mentioned earlier.
Now translate that. Supply constrained means there aren't enough chips to go around. The factories can only make so many, so the chips get rationed. And that one fact changes everything. Because now imagine you're Microsoft. You look at the losses and you think, maybe we slow down. But if you slow down, you stop ordering chips. And the moment you stop ordering, Amazon takes your slot in line. Google takes your slot. Your competitor walks away with the chips you gave up. And you can never get that year back. That's the prisoner's dilemma. The smart move slowing down is the move that kills you. So all four of them are locked in the same cage, spending money they might not get back to buy chips they might not need, purely so the other guy can't have them. And here's the loop that closes it. Remember Meta burning its cash to almost zero? Here's what Zuckerberg let slip.
You have Meta and reporting it's building a cloud business, and CoreWeave is dropping on the news. Can we go through that?
Yeah, actually a pretty big move taking place in Meta shares as well on this news. So the news headline is that they're exploring a new cloud infrastructure business that would sell AI computing power and AI models to external customers, putting it in more direct competition with AWS, Microsoft's Azure, and Google Cloud.
He hinted Meta might launch its own cloud business. Sit with that for a second. Meta is spending itself dry, buying compute from the cloud giants. And now it wants to become one? To turn around and sell that same compute back to the market. The customer is trying to become the dealer. That's not a company investing. That's a company that got so deep the only way out is through. So where does this whole thing crack? Because a trap this tight always has a breaking point. Watch for the first blink. Somebody in this race runs out of runway before the others. And Meta just showed you what the edge of the runway looks like. $784 million in free cash flow. For a company spending $31 billion a quarter, that's almost nothing left in the tank. Then there's the adoption crack. Copilot at 3.3%. If businesses spend another year and the AI still isn't being used, the story flips. It stops being the future is coming. It becomes where's the return? And the third crack? Power. You can order all the chips you want, but there's a backlog of over 2,000 gigawatts just waiting to connect to the grid. 5-year waits. All four are signing nuclear deals just to keep the lights on. Chips you can't power are just expensive paperweights. 3 cracks. Cash adoption electricity. Any one of them fires first and the whole race changes shape. Now pull back. Look at who else is watching this. Because there's a bigger game running underneath. When Google's finance chief said supply constrained out loud, she wasn't just talking to investors. She told the entire world where the bottleneck is. She confirmed on the record that whoever controls the chip supply controls the AI race. And who's listening hardest? Beijing. China now knows the exact pressure point, not the software, not the models, the machines. That one Dutch choke point and the factories in Taiwan. That's why this stopped being a business story a long time ago. Think of it like an arms race between two navies. Nobody wants to build another battleship, but nobody dares to be the one who stopped building first. $760 billion isn't 4 companies competing. It's one country trying to build an unbreakable lead before the other one catches up. The Capex is the ammunition, and the war is already on. So here's your signal. The one number that tells you the truth before the headlines do. It's not the revenue. It's not the stock price. It's free cash flow. Watch Meta's free cash flow every single quarter. If it stays near zero or goes negative, that's your first domino. And watch 2 things beside it. AMD's data center revenue. Is it still doubling year over year? And Copilot adoption. Is it still stuck near 3%? Here's the logic to lock in. As long as the chips stay scarce, nobody dares to stop. But the day free cash flow snaps and the AI revenue still hasn't shown up, that's the day the first company blinks. You'll see it in the cash flow line months before you ever see it in the news. That's your early warning system. So let me leave you with this. $760 billion. Four companies who all know the risk and all keep spending anyway. This was never really about who believes in AI the most. It's about who can afford to lose the longest. The signal to watch is Meta's free cash flow quarter after quarter. Do you think it goes negative before the AI revenue shows up? Drop your take in the comments. And if you want to track where this race actually breaks, follow along. Because the first one to blink won't announce it. You'll read it in the cash flow first.